Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks weighed down by fragile negotiations between the U.S. and Iran. Investors also digesting this earnings season as it continues to wrap up, with the AI trade seeing some strength. Carter Worth, CEO of Worth Charting, joins me here for more on the markets. Carter, always great to see you. Let's start big picture, my friend, because on the market you say here, trim longs, sell calls, and hedge. Why, Carter? Why are you sound a bit more defensive here?
Right. So, well, we know that valuations are terrible timing tools. There's nothing to do with that. It's just that I would characterize the market as full. Right. We've come a long way since the.
What does that mean, full?
Well, a lot of money's been pushed in. A lot of people are in, so to speak. A lot of people believe. A lot of people doubt nothing anymore, that it's somehow Goldilocks, and it's been that way for a long time. To be fair, we know that when you have 10-year interest rates where they are, you can play with the multiple. You can assign any multiple you want, right? And you say, all right, the growth will continue.
Valuation's the eyes of the beholder, right?
Exactly.
Yeah, right.
But at this point, again, just the sheer nature of the steep, uncorrected move since the sell-off lows of March, we're far above trend, however you want to measure that, whether you use a moving average or other price oscillators. But the word full gives you a little, not to say wiggle room, but who's the incremental buyer here? We've also heard from every major company, I think semis in particular, and they've all gapped up in response to earnings, 20, 30%. Intel gaps up, Texan gaps up, Marvell gaps up, HPE the other day, and it goes on and on, Dell, Cisco. At some point, there's nothing left, there's no batter left to go into the box.
What about those, Carter, who push back on this? They come on the show, they say, we should be full, we should be above trend, because earnings have been remarkable, margins are impressive.
Right, so that's all pricing, but the market, as we know, is looking forward. So looking out 6 to 9 months, there are bubbles, and there's also earnings bubbles. What is the, you have to lap these great numbers.
Comps get tougher.
Comps get tougher.
Right.
And so it's become also precious metals, which were adored, people abandoned them, it's not working. Bitcoin, which was adored, people abandon that.
Not even in the conversation.
Yeah, not even the conversation. Right. And so what you're seeing is just, well, I'll just play this one thing. I'll play semis, I'll play tech. They're not embracing, look at the restaurant stocks. You're talking about multi-year lows for the group relative to the S&P, but McDonald's on its knees, Walmart struggling all of a sudden, Costco coming off on its earnings. So it's not so much the aggregation, the chart of the S&P, it's the underlying. It's not about breadth or advanced decline. It's just there are a lot of stocks whose charts themselves are suspect, as there are those that are equally suspect for different reasons. Steep, uncorrected, adored, loved, overdone.
What about this other argument I've heard at this very table this week, which goes something like this? Well, yes, the market's moving higher, but it's being dragged higher by just a few big names. It's narrow leadership. Do you share that worry?
Remember, markets are always concentrated. If you look back over the 50 years, the top 10 stocks are typically 25 to 30%. Right now, the top 10 are closer to 40 plus, meaning markets it's a survivor bias, just as mutual funds that are struggling get folded into other funds and get close. Markets are always concentrated. This is just the nature of things, but we're especially concentrated now, to your point. And I think some people call that a breadth issue. But for my purpose, it's about the behavior of the individual securities that JP Morgan has rolled over, right? Walmart, Costco, again, so many stocks are struggling as the aggregation, SPX, for what it is, gets steeper and steeper.
On the SPX, when clients ask you, what are the levels, Carter, you're watching right now, what do you say?
Yeah, well, I would say also, we try to answer it this way. And I think everyone would agree, you can only do 3 things. Is that fair? Up, down, or sideways? So we got that covered. Now the question is, how do you handicap or put odds? I would say sideways to down covers like 85% of the odds. That really stretching higher from here seems the low probability. Now there are these weird phrases that have crept into the vernacular in the last 15, 20 years. Pain trade. What does that mean, pain trade? I mean, but the pain trade is apparently higher. It's all a question about risk assets and when do you reduce risk? Do you increase risk here or reduce risk? By my work, you decrease your risk.
Let me ask you, you mentioned the chips, the SMH, just a rocket ship off the March 30 low. Can you just break down technically what you're seeing there?
Yeah, so we have one to go, just for what it's worth. We've got Avago, Broadcom coming today. There's a strong case to be made, and I think it's a legit one, that regardless of what happens today, when we get earnings from, or I guess it's tomorrow from Broadcom, that
today after the
okay, it's after the close. That sets the high. Meaning, let's say it gaps up just as Texan did, Intel did, Marvell, they all gapped up 20, 30%. Then that's it. You hear a quiet sound. There's nothing left. There are no batters left. We've exploited all, or it somehow pulls up lame, which would be not what's happened to most of them. NVIDIA didn't act very well on its earnings, and then that's the end of it. But the story, again, it's not a very precise word, but I think it's the word that's right, is full. Who is the incremental buyer? Semis now are adored just as silver was adored before it collapsed. Oil was adored before it collapsed. Parabolic moves have a way of ending violently, and I don't think this is a time to increase exposure. It's time to reduce exposure, to semis in particular.
Let's get to some specific names too. UPS, you like UPS. Why? What do you see in the charts?
Well, that's classic value investing. I mean, this is bombed out. This is a stock that basically down to its COVID lows. It's got a 6% yield. That's either the value trap or the part that's value, whether they cut that or not. But it has all the elements of something that is based and bottomed. So a long and protracted downtrend, unrelenting, 2-3 years, and then it's starting to stop going down, starting to base and cure and heal. And ultimately, we think this is the beginning of what is a decent turn, and we want to be long that circumstance.
On the other hand, you're bearish RTX. How come? What do you see in the charts on that one?
It's the equal and opposite. It's a great winner. This is a stock off its 2022, 2023 lows, went from 68 to 215, almost tripling. And if you consider that versus the aerospace sub-industry group or industrials overall, a huge outlier that's then now started to, just as UPS has bottoming, topping. It's rolled. It's down some 18% from its high, and trading around 175, I guess it is, from 215. And it's all the elements of a bullish to bearish reversal. So a great growth stock that looks quite aged and topping.
Finally here, my friend, you launched the Worth Charting Options Income ETF recently. Explain this to me. Walk me through it, the point and purpose, and who you think it's for.
Yeah, this is for the part of your portfolio that is not out there just embracing every new story, every risk, whether it's semis or energy or what might be the flavor of the day. This is for your conservative money. It is an options income fund. And what we do is we're in the insurance business. We sell short-term, out-of-the-money options. And we collect premium, and we wait for the spots on the banana to start to occur, meaning decay, or the decay. After vol spikes, typically after an earnings move that moves a stock up or down 10% or more, we look to set up a strangle, and we wait for decay. Now there are overlays to that to also buy insurance for anything catastrophic, but think of it as a vehicle for bond-like money to offer, and this is our hope, sort of, let's say 10, 12% returns. That's what we're going for with very little drawdown.
Carter, always great to see you, especially on set. Thank you, sir. Turning now to our chart of the day, Yahoo Finance's Jared Blickery is breaking down why SpaceX's IPO may be a trap. Jared.
Thank you. It's not just SpaceX, could be OpenAI, could be any of these big IPOs, could be a small one too. I got some really interesting data from the University of Florida. This is Jay Ritter. He looked at over 9,000 IPOs over several decades, and he looked at their returns after 3 and 5 years. That's after their first day launch. What these red bars indicate is that most of these IPOs actually dropped into the red over a 3-year period. In fact, I'm going to circle this first group here. Just under 40% were down more than 50% after 3 years. And then 0 to 50% down, that's another 20%. So 60% of IPOs are losing money within those first 3 years. But some of them are winners. So from 0 to 100%, guess what? We got about 20% of the group in there. And then 16% or more double their price. So that means that they're up 100%. Just goes to show you that most IPOs are not moonshots. And especially with a lot of these IPOs that are coming so late to the market, like SpaceX, which has been in business for decades now, well, a lot of that alpha is probably out the window. And if you own the Qs, if you own the Nasdaq 100 ETF, you're probably going to own it anyway after a few weeks. So I just wanted to put some other comments out there and some stats. These come from Kathy Donnelly. Now, she's done some separate work researching IPOs all the way back to 1982, and she found some very similar stats. Only 20% of IPOs from 1982 to 2017 gained 100% in their first year. So that was versus 16% here. She found 20%, but still, it's less than 1 in 5 that we're looking at here. Another really interesting thing, about 91% of IPOs, they will undercut their first day low sometime in their lifetime, and about 1/3 of them are going to do that within 3 weeks. So what usually happens with an IPO, you might go up that first day, you might get that really nice pop, but then you'll typically drift down and you'll undercut that first day low. You'll see things bounce around, and that's when you want to buy the breakout from that initial range. So it doesn't hurt to sit on your hands for that first initial, through that first initial pop, and kind of wait for things to settle down a little bit. Back to you, Josh.
All right, thank you, Jared. Coming up, we continue the conversation around the SpaceX IPO. That's next on Market Domination. Tesla's first official used Cybertruck inventory sells out within 24 hours. Let's dig into why we're seeing this surge in demand. Barron's associate editor Al Root has been following that story. Al, it's great to see you. So why are these used Cybertrucks, Al? Why are they selling so fast? Is this limited supply, strong demand, bit of both? Explain it for us.
Josh, I always feel like I'm talking trucks with you. I think it's limited. I think it's limited demand. I think it's limited supply. So it's good for Tesla, but over their entire history, I think they've sold about 60 to 70,000 of these. These would be the initial ones coming off like 24-month leases and some trade-ins. So I suspect it is mostly low supply. However, it does show that there is demand for a lower priced truck. The magical $50,000 electric pickup truck sort of has never arrived. The mid-tier Cybertruck starts at $80,000, so it's still pretty much a niche luxury vehicle, an odd-looking one at that, as the B-roll shows. But right now it's sort of a low supply story, I think.
Do you think, looking back, Al, and kind of just broadly here, do you think Tesla was just too optimistic that this was ever going to be a truly, high volume mainstream product? That this is going to be a niche product?
Yeah, I mean, listen, I think if you go back to 2021, and the real start of the EV boom, people thought EV demand was almost limitless. Whatever you could sell, whatever you could build, you could sell. Tesla, I had a pre-order. They had hundreds of thousands of pre-orders. You put $100 down, it was fully refundable. So it was sort of like a free, just get your place in line. I used to get the emails, you ready to configure your Cybertruck? No, was my answer. So that was like a false demand signal, right? And don't forget, like Elon said that we'd like to make 200,000 of these a year, and they just never approached it. Price is number one, maybe design is number two. We know that EV estimates were sort of all overstated vis-a-vis, 2020, 2021. So that sort of trifecta, they just never got anywhere close to that.
Who does the Cybertruck, compete with, Al? Who would you say the competition is here?
Well, that's probably the good news. It's probably one of one, right? Like it doesn't really have, I don't necessarily think that if you are into a Ford Lightning or the electric GMC Sierra, I don't necessarily think that's your core customer. If you Rivian, okay, so the Rivian R1T versus the Cybertruck maybe, but again, it's so different. I mean, it really has become sort of, the Cyber Beast, the $100,000, 1,000 horsepower truck. It's sort of like this niche sports car. You might even compare it to like, the Mercedes AMG that just came out, that's all electric, right? Like it's sort of like this niche, super powerful electric vehicle that people like. And don't forget, I mean, not for nothing, the number one customer last year was likely SpaceX, right? They spent like $131 million on Cybertrucks. So it doesn't really have traditional competition, I'd say.
Al, you're also saying in your story, Cybertruck, listen, it's fun to talk about. Okay, but it's not likely to move the stock. It's really the Cybercab, you say. That now could be Tesla's most important model. How come, Al?
Yeah, I mean, remember the good old days when Tesla was an EV company and we cared about sales growth and things like that? I'm sure Pross says this. Now it's all about AI, right? So AI-trained robots, robotaxis, FSD, they're a full self-driving consumer product, which I am a proud user of. So people really just want robotaxi progress, right? And Cybercab there, it's the purpose-built two-seater that Tesla's going to deploy in fleets, and then eventually other people can buy and create their own Tesla robotaxi fleets. So progress on that front is really what's driving the stock. I mean, we could argue about it, but I would say at least half of the stock's valuation is in robotaxis. So that's, we're pushing $1 trillion for that idea. So really, they just need progress on that front. They just removed safety monitors in a geofenced area of Austin, but that entire robotaxi fleet across all of its cities is still estimated to be 40, 50 cars. it's been painfully slow. But investors should watch Cybercab news more than Cybertruck news.
Finally, Al, you got another story out this week. How OpenAI, you say, is coming for Tesla's robot business. Talk about that, and also what do you think OpenAI brings to the table that's different? What's Sam Altman's competitive advantage there?
So two things in reverse order. What is OpenAI's competitive advantage? I actually don't think it's significant, right? For my money, the AI brain, OpenAI, Alphabet, XAI vis-a-vis SpaceX, Tesla and its own data centers, right? The AI training and the AI brain of the robot probably isn't the gating factor of making useful robots that we can all use someday. The gating factor is probably manufacturing. Right, so Tesla's actually probably demonstrably a better manufacturer than OpenAI at this point. So I think having a brain and having a robot product isn't actually sort of the thing you need. I think you need to be able to make these things at scale, and if you can make them cheaply, you'll have a good business. That's Elon's bet. I think two things. I think that the OpenAI announcement shows how just everything is converging around AI, right? So physical, we all have AI, physical AI, whether it's robotaxis or robots, all of these businesses are sort of morphing into each other. It is why Tesla is sort of one of the Mag 7, and the ultimate expression these days of physical AI in the market. If you want to invest in robots and robotaxis in America, you only have a couple of choices, and one of them is Tesla. And one of them is led by Elon, who's a visionary, and people like that. So that's why, it's in that group. It's in the $1 trillion group. It's why it trades for 200 times earnings. I do like when other companies sort of jump into Elon's spaces because it sort of justifies his vision, if that makes sense. NVIDIA talks about robots. NVIDIA has self-driving car technology that they will license to other people. OpenAI wants to make physical AI applications like robots, just like Elon does. So you can see how the ecosystem develops. So in one respect, it sort of justifies and makes people feel better about Tesla. And in the other respect, it makes for some competition. But again, I think manufacturability of robots is what's going to win that war, and that'll develop over the next 5 to 10 years.
Al, as always, great to see you, my friend. Thank you.
You too.
Well, Elon Musk, SpaceX reportedly plans for a fixed IPO price here with a closer look at Yahoo Finance's Praz Submarine. All right, Praz, so we got new details on the terms of this SpaceX IPO. What do we know?
Yeah, so Reuters, Bloomberg talking about this fixed price, right?
Not a range, fixed price, yeah.
Interesting, $135 a share, 556-ish million shares, translating to $75 billion raised. With the 1.75 trillion valuation. What's interesting is that all these numbers are sort of kind of where they were, how they were reported, right? These are what we heard were coming through. This is pre-roadshow, right? Which I believe starts tomorrow. And you're saying, okay, this is what we're offering. It's identical to what we've been hearing from the report. So interesting that Musk and company are confident that they can maybe hit these numbers. Take it or leave it approach, I guess, kind of showing to the strength of the offering and how they consider, the 30% offering to retail. That's supposed to be that's a big amount, and they're confident they can serve that sort of group of buyers. So I mean, really interesting that this number is just there for the taking. I was talking to Julie Hyman earlier today, right? She's talking about what do you think it's going to be, what it's going to open at, and she was saying 250. It's like, really? She's like, yeah, why not? So I think that there's all this pent-up demand before the other big offerings, right?
Those numbers, by the way, that would imply a valuation of nearly $2 trillion. What do you think? What would a bull say justifies that valuation? Is it Starlink? It's the launch business. It's the mythology of Musk. Maybe it's all three.
Yeah, I think you nailed it. I think it's all three. I think it's the big things are in no particular order, right? The rocket launch business, right there. They're the premier payload provider to space, right? Low Earth and regular orbit, right? They can do that at a cost that no one really can meet at this point from a private rocket company point of view. That business is ramping up. Starlink already making a ton of money, right? We're going to talk about this later, but it's a competitor in the broadband space, right? It's making it cost effective. It's making it available throughout the globe. It's an amazing product and used for both commercial, residential, you name it, right? And then finally, the AI stuff. That's the part that people are getting tripped up on, right? What does this mean? Orbital data centers, are you kidding me? This is a thing, this is actually going to happen. If it does happen, then that's part of your bull case. If it doesn't, it's sort of kind of a cost loss there for that business. And what do you do there? Well, we have Colossus. We have other AI products. We're going to push that. It's going to feed Optimus's brain. Tesla might become, is part of this world, right? So you're all sort of betting on this huge Muskonomy thing that we talk about. But in SpaceX, it's such a aspirational thing for investors and for human civilization. I think that's why there's so much pent up sort of enthusiasm for this stock.
Musk has never been a big fan of like Wall Street norms, Wall Street rules, right? Does his own thing. Are you already seeing examples of that in this SpaceX public debut?
I think you're seeing it in a little bit of pushback on the street, right? We saw Morningstar talk about how actually the valuation from my point of view is half what they think it's going to be. With that said, it's still an interesting company. Don't buy it during IPO day or the public offering day. Buy it later when you get it cheaper. There's so many most initial public offerings, stock within the first year is down like half. Saying go buy it then. So you're not seeing Musk. Musk's doing his thing no matter what. You're either you're in or you're not. But Wall Street is sort of, some of these banks are talking about how we agree with the business, we're fans of Elon Musk, but this is too rich right now, especially the governance concerns, things like that. You might see some pension funds not actually think about, we don't want to be a piece of that. But I saw Sam Rose talking about this today, our good friend. Are there any S&P tracking ETFs or indices that can do ex-SpaceX, right? Ex-SpaceX, because it's going to be such a big part of the industry.
Finally, you mentioned this a second ago, but just to revisit, the analysts at Oppenheimer, they downgrade AT&T to perform. So basically, it's equivalent of a hold there. They move to the sidelines, and they're talking about the SpaceX IPO there.
Yeah. It's funny because I see AT&T, it's one of the most boring companies alive, right? These analysts need a reason to downgrade the stock, is that we're talking about here. But analysts brings the fact that, hey, part one, Starlink is a true competitive threat to legacy broadband. Like I said, they can bring basic broadband anywhere without the massive build-out costs. So that's one thing. AT&T's talking about AT&T's fiber build-out. Again, these high-cost, high capital-intensive offerings. The build-out is disappointing. They're tracking 60 million build-outs, but they might do 50 million. There's just a lot of bearishness on that legacy broadband business. Analysts likes in particular Verizon and T-Mobile because they have less broadband exposure. So you're right, broadband might be getting its cake eaten by Starlink.
All right, Bras, thank you. Appreciate it. Coming up, we check in on some of today's top trending stories. That's next on Market Domination. Rapid shifts in tech, health, and luxury are reshaping consumer habits. And here to discuss, we've got Yahoo Finance's Inez Ferrer and Brooke De Palma. Let's start with travel, Brooke. So Bloomberg is out with the story. Basically, even wealthy travelers are saying, you know what, just tell me the price up front. So luxury all-inclusive resorts, they're booming. People spending $6,000, even $20,000 for trips where they basically, you never have to think about money, right? Just arrive. That's the price. It's done.
Yeah, according to Hotels.com, I mean, searches for these all-inclusive stays are up about 70% from January 1st to June 1st. And I think it just sort of plays into this economy where right now we're experiencing higher prices just about everywhere. And we're saying, look, we want to get away. We want to be able to enjoy ourselves and not even look at a bill at all. We just want to be able to see that we're there and just enjoy our experience. And when of course, maybe for those who haven't gone to an all-inclusive, you really don't have to think about anything really. I mean, you get there, you get to go to a restaurant, you don't even have to pay the bill at the restaurant unless you want to leave a tip. It really is sort of a seamless
it's not clear that you're
experience.
saving money. Maybe you just feel better about the money you're spending.
Well, or you're spending the money up front, or maybe you're on a savings plan, so you're paying monthly by monthly. So when you get to the actual trip, you don't have any credit card, payments to make after the trip.
And you're not constantly taking out your wallet for everything. So I would be curious if tips are actually included, because that would be a huge plus. That way you don't have to worry about.
You like this? You like, I get there, I arrive, I hand my credit card out, and then I mentally check out about money.
Look, from the airport all the way to the resort, if I don't have to worry about taking out my wallet and doing everything with a credit card, do you accept? I mean, that would be just so convenient.
Yeah.
Do you see this as a sign of like economic anxiety, even on the high-end consumer, or no, it's a different thing?
I mean, a sign of this experiential economy, this escapism that we're seeing so apparent since I feel like 2022 when inflation peaked prior to this time around. I feel like the high-income consumer does want sort of this escape.
And it's also these companies that are leaning into this, these travel
100%.
companies like Hyatt saying that it's all-inclusive is 84% occupied for the first 3 months. The year you also have Marriott that's upping their demand in this. So they are leaning into just the way they're doing in the airports, in airlines where you have the premium pricing. This is sort of similar, but in a much bigger way, where they're just leaning into that high-end consumer.
I think of like a cruise. We've been talking so much about cruise lines and how they're doing well, or they have been doing well maybe last summer into this year, because of the fact that it is that all-inclusive experience that you don't have to pay yet again once you get in there. And I was reading a recent Bank of America survey saying that 1/3 of Americans plan to take a cruise in the next 12 months. So when you think about it that way, they're planning to take a cruise because they want to be able to not have to pay for things on their trip, and they figure, okay, I can get a good bang for my buck. But like you said, there is a difference with what kind of all-inclusives that you're going for. You don't have to necessarily spend 20 grand like some people are spending on all-inclusive. There is other, maybe a few $1,000s for 1 or 2 people.
All right, story number 2. Reporter Mark Gurman has this scoop. Inez, Apple's building a feature, he's reporting, where you, I guess if I understand this right, you take a photo of your restaurant bill, your iPhone sort of figures out who ordered what, calculates, your tax and your tip, you send the payment request automatically. Is this the end of those awkward group dinner conversations?
Yeah, I mean, it seems to be. It can photograph the receipt, then you can assign items to different people, you can approve payments through your Apple Watch. I mean, it all is so integrated, and it is an easier way to handle the dinner at the end of the night. So instead of both of you putting down a credit card, or 3 people putting down a credit card and split it in 3, you split in the way that you think you should, because
or based
of
on what you got, or something like that. What I will say though is so interesting is lately in New York City, I've been seeing Toast lean into this by maybe even providing QR codes at restaurants so that each attendant can scan it, pick what they got, and then divide the bill that way. So I do wonder what this means for Toast. I wonder what this means for PayPal, for Venmo.
It's Apple's integration that's the strength here. If you work it into
100%.
Right.
Think about it. I mean, I use Tap to Pay. You guys probably
use it.
do
If
too.
you can integrate that into wallet, into messages, what does that mean for third-party apps?
Exactly. There's also companies out there, like we were talking about before we jumped on air, Splitwise. I mean, if you're in my same age group and you're going on a bachelorette party, seems like every other weekend or a lot of times during the year, Splitwise is the go-to, or basically you settle your payments, you add all the things that you're spending on, other people add, so that maybe by the end of the trip, me and you only owe each other $10. Maybe you owe me because what I paid adds up to what you paid and vice versa. So Splitwise, that can impact other companies as well.
So you're not using Venmo.
So we're using Splitwise just to settle up the payments, and then I'll Venmo whoever I owe. I'm pretty sure though with Splitwise you could also integrate your wallet into integrate your bank account. But I've never used Apple Cash. I've only used Tap to Pay. I don't know if they sort of use an example of kids using Apple Cash.
Yeah, it's a very Apple thing because you're taking something. It's a very Apple thing. You take a task, and also they're good at like taking a task or a chore and then making it sort of feel frictionless.
Yeah,
it's an Apple thing. And Apple's big software show coming up, so we'll see if Gurman's reporting is right. It almost always is.
Yes.
Good report of that, Mark Gurman. All right, finally, Brooke, Macy's saying demand for plus-size clothing is softening amid the rise of GLP-1 weight loss drugs. So is this our new GLP-1 economy? Is that what we're seeing here?
It appears so. I mean, this is now a few companies. We heard from Victoria's Secret, we heard from Hershey's, and now we're hearing from Macy's. To keep in mind, CEO Tony Spring on the call didn't exactly tie it to GLP-1s, but what he did tell me over the phone this morning was that petite sizes is showing some strength right now. And what he told investors on the earnings call was that plus sizes is seeing some softness. And so that's specifically what he did say. Now, this article, according to Bloomberg, sort of did broaden it out, sort of weigh into the fact that we are seeing this rise in GLP-1s, and that is causing all these other lingering effects.
Maybe this is the future, though, Inez. It's like across America, you're going to have like, 2 closets. You're going to have 2 wardrobes. It's like pre-Ozempic and post-Ozempic.
The before and after.
Pounds, I'll wear these jeans. If I don't,
you're going to put everything on Facebook Marketplace. Do you want to buy this extra large shirt? Look, I mean, I think that this is a trend that these companies are citing here, but also I found it fascinating. Hershey's saying that mints, and that because of the bad breath that this causes.
Ozempic breath?
Yeah, I find that to be fascinating.
Yeah, it's like all these little tentacles of how exactly GLP-1s are impacting just the American consumer at large has been so fascinating to watch. And keep in mind, back in December 2025, PwC actually said that 20% of U.S. households have at least one GLP-1 user. Keep in mind, that was before there even was the pill offering. And based upon what I'm hearing from so many experts is that there's even more people because of the convenience, the ease of these pills as opposed to the injectables. And so it's likely that that number has grown even more. And apparently people are getting new wardrobes.
Somebody somewhere, Inez, is like, you know what? They made fun of me for keeping my skinny jeans. But look who's laughing.
But look who's laughing now.
Back of the closet.
I fit into these skinny jeans. You go on a buying spree. Look, I mean, this is bullish certainly it's bullish for retail if people are kind of getting new wardrobes because of
Clean out those closets.
Yeah.
All right, Brooke and Inez, thank you both. Appreciate it. The first Fed meeting under new chair Kevin Warsh is in just a few weeks. Warsh faces high inflation spurred by rising energy costs, as well as pressure from President Trump to cut rates. Yahoo Finance senior Fed correspondent Jennifer Schonberger spoke to New York Fed President John Williams this morning about that and a whole lot more.
We're now just over 3 months into the conflict with Iran. President Trump just said that the Strait of Hormuz could remain closed until Labor Day, though he doesn't think that's likely. How do things look to you right now when you look at the U.S. economy?
Well, I think there's 2 factors that are influencing the U.S. economy right now, and they're kind of working in opposite directions. One is definitely we're experiencing higher energy prices, and households are paying more for gasoline and other goods that have a high energy component. So we're definitely seeing some hit to kind of household spending from that, and some negative effects from that. But at the same time, we have this huge AI wave of investment in data centers and AI and technology. So what I'm seeing is an economy that continues to have solid growth, GDP growth around 2% this year, maybe 2.25%, so that's good. And importantly for monetary policy, a labor market that is stabilizing in a pretty good place. We're seeing unemployment be around 4.25% for the past 6-9 months. Latest indicators, the labor market continues to be, I think, healthy, and those are very positive signs. Of course, so that I feel like the economy's in a pretty good place. Now inflation is the other part of that story. We definitely see higher inflation readings, partly because of the effects of past tariffs, but also importantly now because of the higher energy prices. So we're definitely seeing inflation up quite a bit because of that. And I expect, assuming that the strait actually does open in the next few months, I would expect inflation to peak in the next couple of months, but be pretty elevated through the rest of this year.
Well, let's talk about inflation a little bit more, dig into that, because you just said you expect headline inflation to peak in the next couple of months. What if the strait remains closed through Labor Day? And what about the fact that we saw core PCE up 3.3% in April, on a headline basis up nearly 4%, wholesale prices up 6%, and you warned back on April 16th that we're already starting to see higher energy prices being passed on. You're not worried that we could see broader ripple effects for price increases that are stickier? You're not worried about longer lasting inflation?
Well, I am obviously thinking carefully about that, but let me go back to where inflation is really elevated right now, and it's really in goods. So we're seeing it in energy goods and anything that uses a lot of fuel or energy. So definitely we're seeing that, and that's from the conflict in the Middle East. We're also seeing it in imported goods through the effects of tariffs, and there's a third category as well. We're seeing it in prices of chips and semiconductors. That's being driven, I think, in large part, primarily by the AI boom and the global demand for chips. So those are the three areas in the goods category that we're seeing the higher inflation. When you look at services, you look at housing services, other services, that inflation actually has come down quite a bit, and I think it's going to stay relatively steady or continue to come down. So I feel like a lot of the inflation is because of tariffs, because of higher energy prices, but also this added thing about chips. So, when I think about how do I see inflation in the next 6 months or so, I expect the tariff effects to basically be kind of near their peak from the past tariffs. Depending on what happens in the Middle East, hopefully energy prices will stabilize and maybe even come down later when the strait reopens. And on the AI, I think that we're going to continue to have some upward pressure on inflation. Right now, I'm not that worried about dramatic second round effects or persistent inflation. We haven't seen any indications of that. Inflation expectations remain well anchored. We're also seeing costs from the labor side be very contained and consistent with low and stable inflation. Labor market is, I think, in a good balance. So we're definitely getting some drivers of inflation higher, but other factors, I think, are kind of more pointing to stabilization to lower inflation. But again, I don't want to take anything for granted. Watching all these indicators of data very carefully to make sure that the inflation that we've seen recently does not get embedded into higher, more persistent inflation, because that obviously would be an outcome I don't want to see.
So it sounds like at this point you feel like you can look through this?
Well, when you say look through, I think you have to be, kind of careful about what that means. Yes, in the terms of I don't expect energy prices to increase dramatically next year and the year after, so it's more of a one-time kind of effect. But I do think we always have to keep in mind that higher energy prices means higher airfares, it means higher fertilizer prices, which means higher food prices. So there are effects of energy prices and some of the tariffs that probably will last through the year and into next year. And it's really just looking for, are there other signs of kind of inflation getting more persistently embedded? I'm not seeing that yet, but definitely there's a risk of that given, how much of a kind of a boost to inflation we're seeing.
Well, yeah, on the tariffs now, the U.S. is proposing tariffs of at least 10%, new tariffs on imports from at least 60 different countries. So that's another thing, right, that you need to be on the lookout for. And I know you said you don't see second round effects, but...
Right. So, one of the things that did happen is with the court decision, we saw tariffs come down. I think some of these announced tariffs, assuming they go into place, will kind of replace, in a way, the earlier tariffs. So depending on what happens, this could be kind of maybe not a large impulse to higher inflation on its own, but we'll have to wait and see what happens with these tariffs. We've been watching that data very carefully. Clearly, the tariffs are passing through into higher U.S. prices. So if there are higher tariffs, that would be one of the factors to include in the kind of the thinking about where inflation's going.
Given your outlook for inflation, do you believe that the easing bias in the policy statement should be dropped or retained?
My view is right now, first of all, monetary policy I think is exactly in the right place. I don't see any need to raise or lower interest rates right now. At the same time, to get to your question, I do think the upside risks to inflation have increased somewhat, increased significantly actually, given recent developments, especially with energy prices and some of the other factors pushing up inflation. At the same time, which is very good news, we're seeing the economy be remarkably resilient, continue to have solid growth, and the labor market stabilize in a pretty good place. So I do think that those balance of risks to achieving our maximum employment and price stability goals, we've seen the risks maybe on the price stability go up, and some of the risks on the labor, employment side have, I think, edged down a little bit. So, my view is, I don't see an obvious argument that we should change interest rates, but I also don't see an obvious kind of direction where we would go in the future. So the answer to your question is I don't see it. I don't see.
So you would change the language.
I don't think forward guidance is particularly helpful right now in terms of directing. In terms of trying to communicate monetary policy. I think where interest rates are now is where they need to be, and I'd leave it at that.
Well, to your point, you said you don't think the Fed needs to raise rates or lower rates right now. And given that you think baseline headline inflation is going to be peaking in the next couple of months, is it safe to say that you don't think we're going to need rate hikes later this year? For the duration of the year, do you see sort of holding rates steady?
Well, I think it's, I'm going to say it, that we have to be data dependent. And that data dependence means, depends what happens. It depends what happens in the conflict.
But right now, I
feel like we're in a very good place. But we do need to respond if conditions change, whether it's on inflation, whether it's on the employment side of the mandate. Of course, we need to, just be focused as we always are in doing our very best to achieve our two goals.
I do need to ask you about the bond market because you have said that you think you're modestly restrictive at this point. First of all, is that still your stance?
I do think that we are modestly restrictive.
Okay. But the bond market doesn't think you're restrictive enough because the yield on the 2-year Treasury has been 25 basis points above where the current range on the Fed funds rate is right now. Do you think the bond market is wrong that they're pricing in a 25 basis point rate hike?
Well, I don't know about right or wrong because people who are buying and selling these securities are having to come to their own conclusions. And I think talking to market participants, they're very focused on what happens with the conflict in the Middle East. So they come to a view of where are the risks to that, what are the risks to inflation, to the economy, and they come to their own judgments about where interest rates are likely to go. I mean, my reading of Fed funds futures and the bond market in general is, basically they have us on hold for a while, maybe with a slight upward tilt to the path for interest rates. But they've proven to be very data dependent themselves. When the news is better on the Middle East, expectations of yields come down, or yields come down. When the news is maybe not as positive, they move up. So to me, the bond market's kind of dealing with the same issue we're dealing with, which is trying to predict where the economy's going in a very, very uncertain environment.
Coming up, a fund that allows retail investors to get in on big sports franchises. That's next on Market Domination. Sports is becoming a hot corner of the alternative asset world, and with the NBA Finals and World Cup approaching, it's attracting everyone from private equity firms to everyday investors. Joining me now is Super Bowl champion Marcus Colston and co-founder of the Champion Fund. Marcus, it is good to see you. Let's start here. Just explain the Champion Fund to the audience, Marcus, like the mission, the point, the purpose.
For sure. So Champion Fund is an interval fund. So that means it's registered and monitored by the SEC. And what we wanted to do was we wanted to take sports as an asset class, an asset class that a lot of people have exposure to from a consumer perspective, and we wanted to make it accessible as an investment vehicle. So what we've done is we've taken sports, we've kind of broken it down into five different what we'll call sub-asset classes. So teams and leagues, real estate and hospitality, sports venture, some small and mid-cap private equity, and then fund of funds. And we've taken that and we've dropped it all into a managed portfolio. And with it being an interval fund structure, it allows both accredited and non-accredited investors to invest as well.
Do you all think, Marcus, that sports is like a better investment or something that can hold up better than traditional assets in traditional markets? Or no, it's supposed to be something like kind of complementary to my portfolio?
I think it's something that if you think about it as an alt sleeve, the makeup of sports as an entire asset class, like I mentioned, has a bunch of different sub-assets in it. So if you take the real estate aspect of it, it's going to perform, akin to other real estate projects. The sports venture side is going to, perform akin to growth stage technology. So it's really this combination in this managed portfolio approach, which allows you to kind of take sports as an entire asset class and be able to have a kind of a more balanced and managed approach to it.
NBA Finals start tonight. If the Knicks reach Game 6 at the Garden, Guggenheim is estimating more than $15 million in additional revenue could be generated for Madison Square Garden sports. As you look for investment opportunities, is that the kind of opportunities that would be on your radar?
Yeah, I mean, to us, it's a really good example of kind of sports anchored mixed use type of investment, to where you have the sports platform itself, but the game itself becomes a catalyst for economic growth in all the other surrounding areas, right? So whether that's the retail and the other ancillary pieces that are in and around the stadium, sports has always kind of been this economic driver for communities. And I think what we're starting to see is real estate as part of the sports portfolio becoming, kind of another opportunity and another growth lever for some of these sports platforms.
Sports is so red hot, though, Marcus. I mean, team valuations exploding, media rights going up and to the right. Does all that excitement and interest, I mean, everybody wants in, right? Does that ever give you pause? Like, do you ever have folks who are kind of worried, hey, maybe we're in kind of a bubble here?
No, I think we're in a space where the demand for sports is going to continue to heat up. I think where some of that demand goes is the opportunity here. I think some of the big four, the big five leagues that have had the really the valuation jumps over in recent years. I don't think that's going to slow down, but what I do think we're going to start to see is kind of this broadening out to where there are professional leagues that are performing well and just haven't had that media cycle moment yet. To where as the media cycle and the media rights deals enter into those leagues, I think you'll start to see valuations in other leagues start to bounce. So what I think is coming is kind of this broadening out of the sports economy to where these emerging leagues will start to see some of the same growth that the NFL, NHL, MLB have seen over the last 20 years.
One thing you know about private investments, Marcus, is just liquidity. You can't just hit a button and sell. I mean, what do investors need to know before putting money to work with you all?
Well, that was one of the biggest drivers in the structure, the interval fund structure. So the way that it's set up is there's 2 redemption windows per year. So as we mapped out what we call the investor avatar, like we started with the athlete, knowing that some athletes are going to be accredited investors, and over time, some kind of drift into the non-accredited bucket. So when we started to solve for kind of the liquidity needs there, we figured out we were solving for the retail investor as well. So the interval fund structure allows us to take less liquid assets and create a source of liquidity with those 2 redemption windows. So it's not a catch-all, but it is a source of liquidity so that you can take these less liquid vehicles and at least introduce some liquidity to the picture.
Marcus, so good to have you, especially on set. Thank you.
I appreciate you having me.
Coming up, we have you covered through the closing bell on Wall Street. Don't go anywhere. Marcus, that was perfect, man. Thank you. That was great. That was great. I love it. Stocks ending the day lower here. Yahoo Finance's Jared Blickery joins now with a closer look at the market action. Jared.
Thank you, Josh. Some pretty broad-based weakness in the markets. Let's start with the Dow, which is off about 600 points or 1.2%. You can see we are in the red the whole day, and we closed at the lows of the day, so a little bit ominous, but we're only talking about 1.2% here. Nasdaq Composite down 0.9%, not quite the lows of the day, but I should add, too, that its 9-day winning streak has now come to an end. It's not 10 days, and that's the same for the S&P 500 that had been the longest streak since 1995, but that will not advance, and it looks like we're closing at or very close to the lows of the day there. Also want to show you the Russell 2000 down 1.25%, and we got some indices in the green. The Dow Jones Transportation Index climbed slightly into the green there by the end of the day, and semiconductors, the Philadelphia Semiconductor Index, the so-called SOX, guess what? That is another record, the umpteenth for the year. That is up 1.4%, but also moving in the upwards direction. Some green here. We got volatility, and that kind of explains why we saw the majors down today. So the VIX was up just a few points there. 16.01, that is not the panic zone by any stretch, but we also saw longer term yields inching back up again. So we got the 10-year up 4 basis points to 4.49%, and the 30-year, that was up 2 basis points to 4.99%, getting closer to that 5% mark that has caused trouble for stocks before. And might as well show you Bitcoin too. Bitcoin sliding all the way down to 65,000. A few different catalysts there, but the net result is we are pretty close to the lows of the year. There we are. That's a year-to-date chart, so getting back to those February lows there. Now let's take a look at the sector action, and there we see we got energy in the lead. That was up 1.35%. Secondary, we got healthcare, and then staples and materials and real estate. That closes out the green that we're seeing here. To the downside, XLC was down the most. That's communication services, down 1.3%. Financials and tech also underperforming. Also, each of those also under 1% at the end of the day. Well, we got some dark red here. NVIDIA and Microsoft both off more than 3%. Apple off more than 1.5%, but Meta up 4%, Micron up 1%. Let me just show you the semiconductor trade. I mentioned the SOX hit a record today on the close, and despite some of these big leaders kind of flagging here, we do have some outsized winners, as has been the case most of the year. SanDisk up 6%, Western Digital 5%, Intel 4%, AMD also 4%. List goes on. Few losers here, but I want to show you the software sector as well. And here we're seeing another day of broad-based weakness. So we'd seen software perking up recently, especially I believe yesterday or earlier in the week, but not today. And I will close on the Dow Jones Industrial Average here. Aside from the mega caps, we're seeing some nice returns from Walmart. That's up 3%. Amgen also up 3%. But to the downside, we got Salesforce off 5%. So is Honeywell. IBM down 7%. And it looks like American Express, Josh, is down 3%.
All right. Thank you, Jared. Let's look now at how investors are looking at the markets today. Thomas Carroll joins me. He is Stifel's Vice President of Portfolio Strategy. Thomas, good to see you. So listen, red on the screen today, I know, Thomas, but listen, we made big moves off that March 30 low. Your note suggests here, Thomas, that it's really, though, it's fewer and fewer stocks driving those gains. Explain that.
Hey, Josh. First, it's great to be back on. Yeah, I think today is a pretty good example of what we're expecting over the next couple months. If we think back to the March low that you talked about, we've seen a furious rally in the S&P 500, up over 1,200 points. However, that rally has increasingly become incredibly narrow. And so now almost 50% of the S&P 500 is concentrated in 10 stocks, which to us is not a sustainable long-term trend. And so we're expecting a rotation trade to occur here over the next few months, but a broader trade, which we highlighted in this report, is not necessarily bullish overall. And I think today is a pretty good example of that.
So that's interesting, Thomas. What you're saying is, and correct me if I'm mischaracterizing, but you're saying leadership is narrow, but you're telling clients don't hope for that broadening because the broadening can actually mean the overall index stalls or corrects?
Yeah, so it would be kind of arithmetically a stalling of the mega caps, that trade, while the S&P 500 is massively over-indexed to them. So if we rotate out of them into some of the more underloved parts of the market, it's possible we see the equal weight S&P 500 outperform, even though the overall S&P 500 market cap weight stalls simply because it's so overweighted to the largest stocks.
One key indicator you're watching, Thomas, stock dispersion. In plain terms, what does that mean?
Yeah, so it's a little bit confusing, but when you look at the VIX for the average stock, the overall risk that's priced into the S&P equal weight is still very elevated. And so I think that has a lot to do with just the fact that the overall Hormuz situation is still ongoing. Whereas, as you highlighted earlier, the overall VIX index is very low. And so what that's doing is it's driving this massive narrowness in the market where the perceived, risk for the big stocks is very low, even though the perceived risk for the average stock is still very high. And so we find that dispersion to be unsustainable. We've seen this a few times since 2020, and every single time that we see this rotation, we get a nice pullback in the overall S&P 500, even though the average stock is outperforming the index in relative terms.
So when
broader isn't better necessarily.
So when you see a high dispersion, Thomas, that suggests a rotation could be coming.
Yeah, it's basically just the idea that investors have become too complacent on the overall S&P 500 market risk, and so we're expecting a pullback, and so it would show up as a rising VIX and a rotation in stocks very similar to what we've seen today.
So in terms of actionable, moves by investors listening to this, Thomas, is it like, okay, trim your mega cap exposure as we rotate into other opportunities?
Yeah, exactly. We think the overall catalyst here could be the fact that yields have risen so high that we're nearing a pinch point for stocks and the economy, and we may see a slowdown in some of the more interest rate sensitive parts of the economy, such as housing. Some of that data looks a little bit worse to us. And so I think there will be a trade out of the mega caps and the realization that maybe the overall economy isn't as good as we think, and there'll be a rotation into some more of your defensive plays, some of the value plays that have been left behind over the past couple months.
What about, Thomas, the war with Iran? Let's say that cools, oil prices drop. I'm just curious how you try to think through how that big variable, that big dynamic could ripple through the markets.
Yeah, well, there's been clear winners and losers since the war started. Even though the S&P 500 has gone up very strongly, a lot of the stocks that are, more sensitive to energy prices have not really gone anywhere. And some of that specifically, consumer staples, consumer discretionary, a lot of the materials names as well. We've seen a commodity pullback as well. So if we do see a resolution and energy prices are able to move down a little bit, then we could see a bounce, and it fits our overall broadening theme as well.
Finally, Thomas, just curious to get your thoughts on the Fed and what you're telling clients. I had another strategist on the show this week, Thomas. He's telling his clients he thinks a hike is actually more likely than a cut in 2026. But what is your base case? What are you telling clients?
Yes, we are a little bit skeptical on the idea that the Fed is going to come in the first day hike rates. I know the market is pricing that in. To us, the probability of a hike would go up significantly if we see wage growth begin to accelerate in the U.S., which we're not seeing yet, but we'll get some more insight Friday. The Fed is in a very difficult position, though. Inflation is moving up very strongly, and the consumer is additionally under squeeze, and it's driving this massive bifurcation in the U.S. economy, where if you're in the AI CapEx space, you're doing amazing, but if you're everywhere else, you're doing quite poorly, and we see that in the consumer sentiment data.
Thomas, as always, great to have you on the show. Thank you.
It's great to be here, Josh. Thank you.
Coming up, we'll have Broadcom's earnings for you on the other side of the break. Don't go anywhere. Broadcom quarter results are just now crossing the wire. Let's get you those numbers. For Q2, adjusted EPS, looks like that clocks in at 244. That's versus expectations of 239. The Q2 revenue, 22.19 billion, 22.19. The estimate was 22.13. Importantly, the guidance for Q3, they're calling for revenue, it looks like of about 29.4 billion. The street was at 28.61 billion. You can see the stock is down initially here in the after hours, about 3.5%. Of course, remember, heading into this print, the stock had been a rocket ship. We were up about 40% this year. We were up about 90% over the past 12 months. Really, it was just this stock riding that wave of excitement about the great AI trade, which has been driving, of course, strong demand for chips. Broadcom, it benefits from that in a couple different ways. It designs custom data center chips. So it competes with names like Marvell. It also networking chips. Broadcom also sells a whole lot of software as well. But it's really about those AI chip sales driving the story and the narrative here and getting all the attention. Wall Street, by the way, loves this name. I mean, 95% of analysts covering Broadcom, 95% say it is a buy. Zero sells on the street. At least initially here, though, the reaction is disappointment. The stock is down about 7% here in the after hours. Well, for more analyst reaction, we're bringing in Angelo Zeno, Senior Vice President Equity Analyst at CFRA Research. Angelo, always good to see you. So Broadcom reports, at least initially, it looks like investors are disappointed in the after hours. We're down about 7% here. What do you make of the print and the response, Angelo?
Yeah, Josh, thanks for having me. So I think overall the print was fine. I mean, they did have a modest beat as far as what I saw for the quarter, and even the guidance was slightly above expectations. But that being said, we kind of just went through a very strong earnings season across the semi landscape. This is an off-peak name, and you kind of look again at the guidance here. It wasn't a substantial beat. It was something that was, I'd call it, more in line. It does point to an acceleration in terms of the year-over-year growth rate. Let's call it from high 40s to about 80% year-over-year growth here for the July quarter. So you're seeing that acceleration. I'd say the bar was really high going into the print here, and I think that part of the response you're seeing here from the shares kind of point to that.
Yeah, got some comments here as well, Angelo, just from CEO Hock Tan, and a statement saying record revenue, talks about record revenue, operating profit, and free cash flow in Q2. Hock Tan saying driven by accelerating growth in AI semiconductor revenue and strong operating leverage. A couple ways that Broadcom is benefiting from this great AI trade. One is designing those custom data center chips, Angelo, where they compete with the likes of Marvell. I'm just curious, what is growth, what does margins look like ahead, do you think, for that business? And what does Hock Tan bring to the table that gives him a competitive advantage, Angelo, versus a Marvell?
Yeah, so you kind of look at Broadcom here. They're a little bit different than Marvell, but they have a lot of similarities, right? In the sense that both compete on the custom silicon side, both compete on the connectivity side. They don't necessarily make exactly the same products, but what I would say as far as Broadcom is concerned, they're a little bit more tilted towards the custom silicon business as far as their revenue mix, about 60% of the revenue or so, let's call it, coming from custom silicon, whereas Marvell is more tilted on the connectivity side, or the networking side of things. And of course, Broadcom's got that massive TPU business from Alphabet, and that's kind of been a real staple here for Broadcom over the years as they continue to ramp new customers along the way. And that's clearly going to be an important topic on the call, as has been the case for the last several quarters. You want to see what that backlog looks like, how that momentum looks like here over the next couple of quarters. I would say as far as the margin trajectory is concerned, I mean, you kind of look at EBITDA, looking at about 67, 68% here. That's kind of been relatively consistent. We think that kind of remains relatively intact. Obviously, as they continue to see greater revenue tied to that custom silicon business, it does typically have a lower margin than, let's call it, relative to software and other aspects of their business. So the fact that they can sustain, margins along kind of that mid-high 60s level as far as EBITDA, I think is good enough for the street. You kind of, at this point in time, want to continue to see that volume improve as we go into 2027, and especially talk about that visibility. Yeah,
you can see the stock trying to battle back here in the after hours, Angelo. It's sort of off the lows now. The great AI infrastructure build out, Angelo, and the downstream winners there, and beneficiaries like Broadcom, when your clients ask you, Angelo, this build out, how long can it go? I mean, what do you tell them? Is it just going to keep going up and to the right, 12 months, 18 months, 24 months? What do you tell them, Angelo?
Yeah, I mean, it's probably the most important question we get, and really it's all about that tail end risk is the question we always get is, how sustainable, how long is this sustainable for? And what we really got in this Q1 earnings season is a number of inflections, right? I mean, we really saw this kind of agentic AI inflection really kind of resulting in a massive increase in terms of the backlog from a lot of these cloud companies. We've seen token generation really kind of inflect a lot higher here over the last couple of months. And when you start thinking just about just kind of the shift towards more inferencing AI workloads, it's created obviously a number of bottlenecks across the industry. And that's really what the market is chasing because of the earnings leverage across those bottlenecks, right? But also what's important is the fact that, hey, listen, the fact that we are seeing the strong demand, the strong backlog, we are seeing the AI monetization from the Anthropics of the world, proven use cases. I think the expectation now is that this can go longer than we previously anticipated. And I think there's visibility at least through next year that the CapEx spending environment will continue to increase. And as long as the backlogs, the demand trajectory continues to increase as we go into 2027, then I think the question is 28, 29, what does that look like? And you would think that continues to be a favorable environment as long as the demand is there. And at this point in time, it just let's see how things play out.
Yeah, Broadcom offered a forecast here, maybe for the current period that maybe disappointed some investors, at least initially here. But your point, Angelo, is well taken as well. Expectations were so high heading into this print. Yeah. The stock's a rocket ship. As a bull on the name, heading into the print, you were up 40% this year. You were up 90% over the past 12 months. How do you think about valuation for Broadcom, Angelo?
Valuation looks good for Broadcom. I mean, it's about 23, 24 times our calendar of 27 estimate at this point in time. So what's really interesting, and you think about the kind of the chip landscape right now, the two big winners here over the last 3 years or so has been NVIDIA and Broadcom. And, they've taken the lion's share as far as, the CapEx spend. But what's happening right now, I think, is clearly there are some investors out there leveraging or taking gains in those names to invest across other aspects of the semiconductor landscape. Some of those more bottleneck oriented areas of the market that it is seeing greater earnings leverage and moves in those stock prices. So I think you are seeing some of that, and maybe you're not seeing as great kind of momentum in, let's call it the big two out there, that being NVIDIA and Broadcom. But when you look at the valuations of both NVIDIA and Broadcom, NVIDIA about 17, 18 times next year, Broadcom about 23, 24 times, at least from a valuation perspective, I think the risk reward in those names remain fairly enticing.
And what is the risk, Angelo, when clients ask you, okay, you're a believer, you got to buy, but what are the risks I need to think about with Hock Tan's company? What do you tell them?
Yeah, I mean, as far as the risk is concerned, I mean, I think at this point in time, it really is the sustainability of kind of, the orders that we've seen here. I mean, clearly they're adding new customers here. The ramp of Anthropic as well as OpenAI as we go into 2027 is clearly a risk, right? I mean, we need to see them really demonstrate the AI monetization on theirs, and we're obviously seeing it from Anthropic's side of things. There has been very strong momentum there. They've done a capital raise. We're going to get the IPOs later this year, but you really want to see them continue to show that monetization to keep investors believing in kind of the trajectory of those customers, because those customers are going to represent a good chunk of the growth opportunity for Broadcom as well as others across the chip space as we go into 2027.
Angelo, as always, appreciate that instant analysis. Thank you.
All right, thanks for having me, Josh.
Coming up, we speak to the CEO of the company behind the famous World Cup sticker collection book. That's next on Asset for a Trend. Hello and welcome to Asking for a Trend. Well, the iconic world of cup sticker collection is back for 2026, and maker Panini is distributing more than 10 million sticker albums across the U.S. and Canada. We have Panini America CEO Mark Warsop to look at the fine print of the collectibles market. Mark, it is good to see you here. So help me just understand big picture, Mark. These sticker albums, why do they become such an obsession for the World Cup, Mark? Like, is it like nostalgia, the community? What is it?
Oh, it's a mix of both. And Panini's been doing the official World Cup since 1970, so it's been a building phenomenon around the world for many, many years. And you know, it almost simplifies the start of the World Cup when we launched the collection. The album itself has all the players in it from all 48 teams. So you know, it's a part of opening the pack, seeing your heroes come out the pack, completing the album. And then it's all about community too. You know, people are swapping in the playground, they're swapping at retail events, they're swapping at organized events. So, you know, it's everyone coming together to make sure they fill their book before the World Cup starts.
And this year, of course, the World Cup comes to the U.S. So I'm just curious, Mark, what kind of impact do you think that could have on like soccer collectibles here in America?
Oh, it's huge. I mean, we've been you know, doing the FIFA collection in the U.S. now since 2010, and every 4 years we've seen massive growth. But this year in particular, with it being staged here, obviously, you know, we've seen unparalleled growth, I would say. We've already distributed 2 times more than we sold in the lifetime of the previous World Cup. And
I was going to ask you how many sticker packets you think you sell in the U.S.
Well, in the U.S., we're still going. I mean, we're into the hundreds of millions of packets.
Hundreds of millions?
In the U.S. and globally over 1 billion packets already distributed before the World Cup starts. There's 7 stickers per pack, so you know that equates to more stickers distributed at this point than people on the planet.
Unreal. Do you consider the U.S. Are we like a real soccer collectibles market now? Can we go head to head with like Europe, Latin America? How has the American market changed?
Oh, it's changed like unbelievably. I mean, like I say, we launched our first FIFA World Cup sticker collection in the US in 2010. And then we branched into doing what we call US-style trading cards for FIFA for the first time in 2014. But it's now a full trading card collectible market for soccer. And the volumes are, you know, they're not too dissimilar to some of the domestic sports in the US.
Yeah. What makes a sticker valuable in all of this, Mike? Like, is it just the big name? Is that it?
Yeah, I mean, well, what we've done differently in the US than any other territory around the world is we've actually done some parallel versions of the stickers. So normally all the stickers are printed in equal quantities, but because the US market is such a like highly collectible market, solely in the North American market, we've injected some parallel stickers, which are varying different color parallels or in varying different scarcity, all the way down to a black one of one of each of the individual stickers. So someone very fortunate is going to find a one of one of, say, Messi or Jamal.
How much is something like that worth?
Well, 4 years ago, a Messi sticker sold for over $100,000.
Wow.
So don't stick it in the book, put it in something to protect it and keep a hold of it.
Well, I'm curious the role of social media, if at all, Mark. TikTok, YouTube, what kind of impact has that had on all this?
Again, huge from a marketing perspective, but also from a collector community sense, it's huge. We've developed our own soccer hub on our own platform where collectors can go on, put in their zip code, it will show them where the closest community event is so that they can go and swap. Because, you know, the idea is that you will fill the book. We want people to fill the book so that, you know, you come back and collect again in 4 years' time.
In our digital world, are you surprised that people still like something physical, a collectible?
I mean, we have a digital version of the collection. It's housed on the FIFA website, and it's in conjunction with Coca-Cola. You can find codes in our packets and also on Coke product to collect the digital stickers, but it just never takes away that, you know, tangible feeling when you open the packet, you see the surprise what comes out, you carefully place it into your book. You know, you just can't replicate it. And although digital's been around for a long time, we've actually seen our World Cup sales grow tournament by tournament every 4 years.
Do people look at these stickers as investments?
I would say because the sheer volume of people that collect the book, and there'll be millions of completed albums around the world, so there's not a massive amount of, you know, financial value in the album after it's complete, but it's that passion and enjoyment of doing it and the community value that I think people like. Obviously, these rare parallels that I've spoken about, those individual stickers in their own right will be worth a lot of money. But the actual completed album itself is more of a keepsake and a passionate fan thing to do.
And you're making these stickers, Mark. So I'm just curious, any big changes in your input costs? And if so, how you're navigating that?
Yeah, I mean, this World Cup in particular, we're expanding to 48 teams, presented some pretty tough challenges for us because the last 6 teams didn't qualify until the end of March. So it was a very short window to manufacture the product and get it to market. We manufacture in Europe, we manufacture in South America, and we're probably producing in the region of about 50 million packets per day just to keep up with global demand. But it's an incredible manufacturing feat, it really is.
How's the kind of competitive market changed for you all over the years? I mean, you're going ahead with names like, there's Fanatics out there. What's the competitive edge you bring?
Well, I think just this nostalgic part of it. Panini has been around and done soccer products since 1961. The first FIFA collection was 1970. And, a lot of people think of it as a Panini World Cup sticker collection. So, I think that nostalgia part is there. Obviously, holding rights is important. And, we've worked with football federations for decades.
Last question. I mean, you've been doing this a long time, as you said, Mark. Is there one sticker that really stands out in your time? Is there some iconic sticker?
Well, I mean, it all depends what team you support, but from a value perspective, the ones to look out for this year, I would say, is Messi and Ronaldo, probably their last World Cups, Jamal in the US, Pulisic, Mbappe, the high-profile players, and then you'll see some player stickers go up in value as the tournament progresses, depending on who might win the Golden Boot, for example, performance on the field. But I would say those are the ones you want to hold on to.
Mark, great story. Thanks so much for showing up. We appreciate it.
You're welcome. Thanks for having me.
Stick around. Much more As for Trends still to come. Shares of networking company Cisco have surged in the last year as it benefits from the AI infrastructure boom. Yahoo Finance executive editor Brian Sozzi spoke to Cisco's CEO, Chuck Robbins, on opening bid.
I remember my first computer, and I remember how powerful I thought that computer was in a standalone mode. But when I connected it, or when it got connected to other computers, and I could communicate and we could do things, it became immensely more powerful. And it's no different than what we see today. GPU standalone, power. Connected GPUs, more power. Connecting GPUs to the enterprise and to the edge securely, it's just more powerful. So when you do that, you have much more power in that network architecture than you do in these standalone nodes. The nodes are super important, as is a network, and that's the point we were trying to get across.
Chuck, it was a couple of weeks ago, your quarter blew a lot of minds on the street, but it got the ball rolling on what we have seen in the week since from Dell and HP, you name it. I think investors forgot that infrastructure is cool.
Yeah, it's actually, in this era, infrastructure is definitely cool. Look, at the end of the day, everything that's happened over the years has always required high performance infrastructure. I think to some extent along the way we forgot about it because it just works. But building the silicon, building the optics, all the underlying technology that allows the global economy to operate candidly on a daily basis, as long as everything's working, people don't think about it very much. And I think now with these massive build outs to train the models, to provide inferencing, telecom providers building out their infrastructure to support the traffic flows, enterprises modernizing their infrastructure to be prepared and to deal with concerns over some of these emerging models. Infrastructure is very important right now. Secure infrastructure is very important right now.
How would you've been around this business for a while, Chuck. I'm not calling you old. I mean, it just is.
You are. It's okay.
It's on your LinkedIn page. You've been doing this for a while. How would you compare what we are seeing today with this AI infrastructure build out and the build out of the internet in the late 90s?
Yeah, I think a couple of things. Number one, this is happening much faster, honestly. Number two, I think it's going to be more impactful sooner. Number three, the capital being invested is being invested largely by companies who have great balance sheets, great businesses, largest companies in the world, and they view success in this technology area as existential to their future, which is why you see so much massive spend happening out there today. And so, do I think that there'll be misplaced capital? Sure. Do I think there'll be companies that won't be successful? Yes. But the winners will emerge, and we'll, just like we did in 2000, we rode that wave for 25 years of all the great technology evolution and everything that we've seen occur as after the winners emerged and the industry just continued to mature. And I think you're going to see the same thing here.
How much runway does the AI infrastructure in America have left to build out? I mean, is it a decade plus year thing?
It's the end is nowhere in sight, I can tell you that. So I don't know whether it's 5 to 7 or whatever it is, but we haven't really begun to build out massive capabilities around physical AI, around robotics, around the consumer side of robotics. I mean, these are things that are all going to have to happen, and that's just all going to continue to require infrastructure. We haven't seen the massive inferencing build out yet. We haven't seen the enterprises really build out their infrastructure to be ready. We believe that over the next 3 years, at a minimum, network traffic's going to triple just from the deployment of agents, and we could be way off. It could be more. And then when you get real-time robotics and those kinds of things running in the infrastructure, it's going to just continue to drive up the demand for network infrastructure. So we see this going on for quite a while.
Is this are we in a networking super cycle, or are we about to enter one?
I think we've entered it. I think we're in it. We're in the very front end of it right now. Simply because every customer we have is investing in networking right now. If you look across our customer segments, up and down the stack, from small businesses to enterprise to public sector, obviously the cloud players, the AI players, the telecom providers, they see their future in this space. Everyone's investing in capacity. And so I think we're actually in that super cycle now.
You mentioned concerns around some of these models that are coming out, and look no further than Anthropic and Mythos and all the mythical things being talked about there with that one. Like, what are your concerns with these models?
Well, there's first of all, I'd say there's a lot of positive benefits with these models too. Just as an example, in 8 weeks, we ran 1.8 billion lines of code through Mythos. 1.8 billion lines of code in 8 weeks. It would have taken us 8 years to do that. And it was across 25 different programming languages. So this is, there's some upside for this. We think that it'll help us over time. It'll help us, and every software company on the planet will deliver higher quality code and more secure code. We just got this interim time we have to work through. I'd say the biggest issue is that it's actually highlighting the amount of technical debt and technology that's sitting in our customers' infrastructure, not just from Cisco, but across their entire IT infrastructure, that is past the last day of support, that can no longer be patched, that maybe have vulnerabilities that were never patched. And I think that's the work that we put out in this. We put out a white paper called Shields Up, which gives our customers some advice on how they should be thinking about what can they do now, regardless of whether they've even seen these models or not. And this is a big area that's going to have to be addressed over the coming 6, 12 months, 18 months, 2 years, because that's going to be the biggest exposure for our customers.
You, of course, have a big security business, Chuck. How does demand look like there? You know, you were talking about agents. I mean, agents are starting to run amok inside of companies doing things we never even thought could even be possible. Like, what type of security risk is that bringing to large enterprises?
Well, I think it's going to bring some risk, and that's why we're investing so heavily. Others are investing heavily in bringing agentic security solutions to bear. What I would tell you is that we believe, and most of my customers agree with me, that the merger of security into the network is the most critical thing, because these agents are going to be operating all over your infrastructure. And many of them are going to have low latency requirements. If I'm an agent and I'm operating at the point of interaction with my customer, I'm going to need very low latency, and I'm going to have to apply security as that agent is operating. And that can only happen in the network. You can't route it over to some inconvenient appliance. And so what I've talked about with our teams are, none of my networking competitors have a security business, and none of my security competitors have a real networking business. So it's something that we need to deliver for our customers. And we also need to partner tightly, honestly, with the security ecosystem if we're all going to make our customers safe over time.
I was talking to Snowflake's CEO a little bit about how they're using AI inside of their company, and he was saying he started to reallocate teams, taking teams from areas that may not make a lot of sense right now because of AI and moving them into other areas. Like, how does this AI roll out inside of Cisco? How does this impact the people function?
Well, so there's a couple of ways to think about that. Number one, from a development perspective, we have to get our resources from certain areas today into silicon and into optics and into AI. So we're making rapid moves of our research and development teams. If you look at coding as an example, every developer, every engineer in our organization is using Codex or Claude or one of these development tools, coding tools. And what's happened now is we're generating so much code that the bottleneck has moved to the validation phase. So we have people now that own the coding process, but they're very active in testing, verifying, and validating the code. And I think you're just going to continue to see us do that and continue to move. But this is something we learn more every week, and we have to adapt and be agile in our business to actually be ready to do what's necessary to continue to be successful.
Does that change how you hire folks inside the company?
I don't know that it does. I think what we want to do, well, let me say it does. We want to hire AI forward people. And I think there's one of the things I believe is that we're doing this current graduating class as an example, in this current generation. I think we're doing them a disservice, scaring them to death about jobs. I think we need to talk to them more about what do they need to do to be best prepared. We're going to the college campuses this year. We're going to be hiring there because we think these people are going to be technically proficient and they can adopt AI, and they're going to do a great job for us. And so I think AI skills and the ability to use AI to be better at your job is the big thing that we're looking for.
Lastly, Chuck, you had a conversation with Starbucks CEO Brian Niccol at the event. We know Brian quite well here. How is he using AI at Starbucks?
Well, Brian's a great friend, and he was very gracious to come over and do that for me today, so I really appreciate that. I mean, he talked a lot about how they're using AI to optimize their inventory in their stores, how they're using AI to actually even further personalize the experience for their customer as they come into their stores. And I think they're using it in a lot of really creative ways. And they've always been a digital first, forward leaning company when it comes to applying technology. And I think they're doing the same here.
Stick around, much more Ask for a Trend still to come. Time now for To Watch Thursday, June 4th. It's going to be a busy day ahead for investors with earnings from key consumer brands, including Lululemon, and from the software sector with DocuSign, plus insight into the labor market. Starting off in apparel, Lululemon set to announce its Q1 earnings. Analysts expecting earnings to be a real test for the impact of tariffs. Sales expected to rise about 3%, with online sales rising nearly double that. Investors will be watching closely with Lululemon preparing for a leadership shakeup with a new CEO in the fall. Looking at software, DocuSign announcing its first quarter earnings on Thursday. Analysts expecting the rise in infrastructure costs to weigh on margins. Buybacks also in focus, which is expected to pick up even more in Q1. Taking a look at the labor force, economists forecasting weekly initial jobless claims to hold steady compared to the week prior at 215,000. This coming ahead of the Friday's highly anticipated jobs report for May. And finally, we're getting weekly mortgage rate data from Freddie Mac on Thursday. Current rate on the 30-year fixed is 6.53%. This is after 2 straight weeks of increases. That's a wrap on today's show. Thanks for watching.